Okay, so hi, good evening, everyone. So thanks for joining us today for the Gold Outlook 219. Will safe haven assets stand tall in 2019? So I think before I start the session proper, um, we'll take a Q&A at the last 15 minutes of the webinar. So before that, I think you can feel free to key in your questions in the Q&A box, and I'll do my best to answer them later. So, okay, before I start, maybe I think I can share a bit about the webinar. So I think we will share our house view on gold prices. What are some of the fundamentals, the movers and shakers of the industry? Maybe I'll dive a bit on economic, geopolitical, and market risks, and also do a little bit of technical analysis. So hopefully all our viewers today can have some good takeaways for gold prices in the current term. So I think before we begin, I have to go through my disclaimer as I'm tasked by my compliance department to share on our presentational disclaimers. So do note that this content is an expression of belief with ample research and analysis done by myself on the subject. In a nutshell, for clarity, please seek advice from myself or my colleagues anytime if should you have queries. So you can actually, in the end of my slide, I will give you the contact details, so you can speak to your respective AEs or account managers, and they will help you with any queries that you have. So for presentation agenda, I think our presentation agenda is quite simple. So the narrative is simple. We'll go through a sequential approach. First, I'll cover a market recap. I think gold for the first half of 2019, in the last 4 months, is a story of actually two halves. So I'll go through a bit. I'll say, assess market fundamentals. I'll provide you guys with a short-term technical analysis, outlook for gold prices in the near term, probably for the second quarter in the first part. Next, we will touch on key market themes for 2019, go through a macroeconomic view and how this will actually impact asset classes and gold prices, of course, in the current term. Our highlight on economic fundamentals, I think the effects of populism on global politics, which is very important, geopolitical risks, and also other rising market risks, which are key drivers for gold prices. And that will actually shape up our house view on actually asset classes in the coming term. So in the third portion, market assessment, I'll go through technical analysis for spot gold, my postulation and viewpoint on pricing direction and levels. I'll dive into technical analysis to give you, maybe some guide on where support and resistance for gold will be going. So in the last part, for some of our new friends who are interested in trading gold but might not have the knowledge, I'll share a bit on how investors can trade gold, some variables for the product class, and maybe how can you trade spot or gold futures depending on the requirements and regulations in your country. So okay, without further ado, I will start this session. So COMEX Gold, you look at this, a story of two halves from the last quarter of 2018. So we saw actually gold prices seeing strong support at 1160, 1185 before breaking up the bullish channel until about sometime in February 19. It appreciated by 5.1% since it's from previous lows. So actually we have seen that there are many fundamental reasons behind the bullish breakout from June, from actually December to February this year. So what are some of the reasons? I will share with you a bit the fundamental part of the story. So actually we saw rising safe haven appeal in 2019. So global growth outlook was at the slowest pace since 0708, the financial crisis. So actually the IMF has already forecast for slowing global economic momentum. I think actually cut its forecast twice for this year and the next. So there's several reasons behind this if you look at it. First is, of course, the hawkish US monetary policy. So the US Fed has already hiked the interest rate 9 times. So all this, the effects are expected to actually weigh in on US corporate earnings, constrict market liquidity, and financial credit in the global market. So all this have a very bearish effect on corporate earnings. So actually the market, when they priced in, the market is always very forward looking. They're looking ahead. It was quite dim, the outlook for 2019 in the beginning. So also the positive effects of US fiscal stimulus and the corporate tax cuts that actually boost markets in the second quarter of 2018 is expected to wear off gradually. So without further economic stimuluses and very hawkish US monetary policy in the start, along with divisive US political conditions where the House is actually with the Democrats and the Senate is actually with the Republicans, we feel that this would actually impede, right, any increase of federal spending or fiscal stimulus as we move in 2019. So also we saw that also one of the reasons is global central banks, by seeing all the softer prospects, they started to hoard gold. Actually, that's what it actually boost prices all the way up to 1345 for spot gold sometime in February. And lastly, of course, we saw the effects of populism, Brexit. We saw US-China trade tensions, and also even in Italy and Brazil itself, it actually raised market risk. So all these actually cumulatively supported gold prices. But what happened actually next, in the last 2 months, is that we saw first a very bullish rejection from technical standpoint at 1345. It's a lot of headwinds, a lot of actually weakness, you see. But why is this so? You see, what is important to note is that gold prices has failed to actually stay above 1302, which is actually quite a crucial point. Failure to stay above 1302 or the key psychological level of 1300 has a very bearish effect on gold prices. So we have seen actually for the past 2 months, gold prices actually made a reverse. It looks like it's going through a correction. It actually fell by 4.6%. So why is this so? If we look at from a very fundamental perspective, you will see that actually the main reason is a very strong, robust risk appetites for the current term. So it actually dents Bullion appeal because gold is a non-interest bearing asset. So some of the factors, as you can see, is that Asian stocks have actually rallied for 9 months, the US S&P index 6 months. So at US S&P index, it reached actually record high last night, and it looks poised to break actually our target 3,000 points. So why on the back of this, I think largely the market expectations are extremely upbeat. They are looking at dovish US monetary policies, which the Fed officials actually called for patience. And of course, through the Fed statement, FOMC minutes, the US Central Bank is actually expecting for a rebound in economic conditions by the second half. To us, it's a little too upbeat, but we have seen a very strong positive consensus in the markets, and as such, that has actually pressured gold prices lower. On the second point, we see market sentiment shifting. Signs of progress from US-China trade negotiations has actually boosted market optimism. They feel that the impact is not going to be as huge, but in our view, supply chain disruptions have already been enacted. So it's not that easy to actually reverse what has been done. But the last key point, I think the markets have been very, very positive, especially when we see Asian stocks rallying for 9-month high, right? Is actually due to Chinese fiscal stimuluses and policy intervention. Now, Beijing has noted that with the financial deleveraging policies that they've enacted in the past 2 years, it's going to have a very cooling effect on its economy. So they've actually ramped up the fiscal stimuluses, cut reserve cut ratios to actually prevent a sharp slowdown, and this has actually helped to support the Chinese economy, as there was a slight upturn in March, actually, as we saw. So collectively, all this have actually boosted Chinese the global market sentiments, global risk appetite, and that is actually the most severe, I think, component that has actually impeded upside potential for gold prices in the current term. So I think, with that being said, I think if you look at the whole picture for at least for the second quarter, we see that I think we are mildly bearish. I think gold, from a technical perspective, gold can't stay above 1302. It has broken 1278. Technical selling activities look poised to come in. The fundamentals for gold, actually, if we look at it in entirety and totality, it is still positive. We are still optimistic. But if we look at market sentiments and the consensus in the ground, we can see that it is not too good. So actually, if you look, we will say that, okay, some of the reasons that have actually pressure gold prices is because that the US-China trade truce has been some solid details. They look like both parties will probably hash out the deal. It might not cover every single point of the IP issues and technological transfers, but they will definitely push something out to prevent, I think, market sentiments from actually turning bad and sell off. The last thing they want is a sell off in the financial markets that happened in the fourth quarter. So robust risk appetites, as we see from global equities. We look at the dollar, we look at actually every asset classes. We see that this has been very, very positive. And of course, the dollar has been very resilient as cause of global interest rate differentials that has happened over the years. Although the Fed fund policy has been very accommodative, but they haven't really cut rates, so it's still quite resilient as in comparison with the other currencies. So, but lastly, we feel that it will not be a total slide in the precious metal because global growth momentum is still weak. And this is actually the latter half where we feel that will impact actually, that will be positive for gold prices long term, and thus this decline in global growth momentum, subdued economic momentum, this will support gold prices in the longer term. So even as we look at this, I'm just going to show you the money managers, I think the hedge fund sentiment on COMEX gold futures that we saw last week. Actually, the release came out. We saw that actually bearish short positions have actually tipped long positions by about close to 3.5 thousand positions. So we can see that normally there has been a very sharp drop, sell-off actually in the money managers. They used to be net long for the past 4 months before they are net short now. And yeah, so actually is more like a long liquidation rather than net short, if you can see. So short positions are actually just streaming here, it's just moving a gentle uptick, overtook, but long positions are actually being liquidated. So I think at least for this quarter, it shows that, money managers starting to book some profits. They might wait again, but it's not like the market sentiment is totally short gold as compared to, I think, the fourth quarter last year. Okay, so trading outlook, if we look carefully, I think we can see that, for example, initially there was a bullish rally in play, but of course failure to breach the technical resistance is quite close over here. It's presented as much headwinds. 3 months decline, I think it looks like the market is going to revisit and retest the 61.8 mark, which is about 1250, 1245. So we think that, as long as it fails to stay above 1302, it's difficult for us to postulate for a continuation of the positive trend scenario. So I think in our view, it's quite important that the prices close above 1278 and also 1302 before we can expect for gold prices to even challenge 1325 in the current term. And stochastic oscillators, I think the readings from a monthly perspective, right, it looks like it's dipping down. So it looks like a bearish correction is in play. But for us, we feel that there's a very strong chance that it might revisit this area, the 61.8 of the FIP, the retracement level. I think at most, it might, if it really breaks the 1,200 mark, it might visit the 50.0 mark, but we don't think it will happen for now. But for now, we feel that it's on track, en route for a bearish correction. That is our view. Okay, so as we look ahead, the next thing I'm going to cover is actually key market themes. So this is going to be for the longer term. I will try to set the framework and actually see how to share with you on our view. Why do we think that actually gold will shine bright actually for the longer term, despite this short-term bearish correction and this short-term sentiments? Long-term bullish for us, short-term bearish. So I think there's 3 key themes that have actually encapsulated our view. The first is that we expect for a global growth slowdown, subdued global economic momentum. We do not see it as a sharp recession, but we see it like it's like a cyclical, structural kind of weakness that is likely to impact global markets. And next, we see heightened geopolitical risk. We've seen the rise of populism in global politics, trade protectionism from US, even after it looks likely to resolve US-China trade issues, but the next effect is the US-EU and Brexit uncertainties, has already impacted market confidence, and it's looked likely to track to the third quarter of this year. And apart from that, Eurozone, there's Italy, and even in the emerging markets, there's Brazil. And lastly, we feel that risk-off sentiment is likely to come in as risk aversion, will likely build up in lieu of the 2 following factors, and there's growing market risk, which I will elaborate a bit more, or like the U-curve inversion, flatter U-curve, and also we are in the later stages of the economic expansionary phase. I'll elaborate a bit more on what I feel, but first, let's look at the global markets. So the first thing I'll say is that we continue to postulate for a very subdued global economic momentum. So we can see, we feel that this recent weakness of global growth is likely to persist for much longer. So we see that, of course, the IMF, as I said earlier on, has cut growth forecasts. There's actually growing downside risk. If there's even geopolitical uncertainties, economic weakness, we see with US trade protectionism. And the previous policy tightening, we feel, has yet to take its full toll on the US economy. And China's stimulus is rather, I think, modest. it's difficult for it to actually prompt a sustained, I think, significant pickup in growth. It will help to support, but it's not going to change, I think, much. So with that, we will feel that the lagged effects of monetary policy tightening, U.S. fiscal stimulus will fade. All this will actually slow the economy gradually. So with that, I think developed economies, I think, to remain rather sluggish. I think even for eurozone, expected to stay weak. The PMIs are not so good. Germany is not doing as well as expected. Even Japan and the rest is also, they are really hanging there. I think largely the bull market has made its run for 10 years. So overall, we are seeing a cyclical slowdown for now. So if you look at, for example, the global economics update, I've pulled out the GDPs for 4 countries, US in blue, China red, and Japan yellow, and Eurozone in green. So of course, China, we saw actually a slight uptick. They expected about 6.3%, but largely it was at about 6.4%. So I think this gave some, market sentiments were a little upbeat. I think they feel that in the case of China, where the fiscal policy is likely to actually boost the economy, I think we hold a contrarian view. We feel that it's much too soon to call a recovery. And also China actually changed its view with the slight upturn, right? China has actually called for easing in fiscal stimulus. You see, because that is to balance out the deleveraging program. I think China is is a heavy debt level. So I think they are going to manage this structural risk. I think they're going to have some restraint on policy. And as such, I think this will limit the scale of the rebound. Upside potential is not that high. We still feel that for China, the risk of our growth is skewed towards the downside, which I will show you a little later. As for yellow, we look at Japan. I think yes, of course, we saw some gains, but once again, we feel that Japan is a country that actually the demographics and everything is quite weak. The labor market might slacken a bit. Inflation levels has been subpar, and we don't actually expect for much additional monetary stimuluses. So I think it will likely range, but I don't think we can see a really sharp ascension. So that is why it contributes to our viewpoint. So US, of course, we saw in the second quarter over here, they actually went up thanks to the corporate tax reform, fiscal stimulus packages, but it has been on the downtrend, I think, for the last 2 quarters. Likely it will hit about 2.1. I think economists are expecting 2.1. It will be released sometime this week. So overall, I think if we look at the global growth prospects like GDP, I think it's going to be rather, I think, disappointing. As now monetary policies has been quite patient, but we do not see any very sharp. We do not foresee a sharp turnaround in global economic conditions, and that is why it is actually the positive consensus that we see in interest-bearing assets in global equities. It's not going to, in our view, it's not going to stay for long. It might still be positive in the second quarter, but we feel that in the third quarter, once it comes the releases on corporate earnings for quarter 2, it's not going to. At some point, they have to actually factor in for this. So this risk aversion, we feel it would actually boost safe haven appeal in the longer term. And if we look at forward-looking indicators like the global PMIs, I think partially the reason for the upbeat sentiment in this quarter is because you see there's been an uptick, for example, in the US ISM, but and also for China, there's an uptick over here. You see the Chinese PMI has actually moved up a bit. But overall, if we look comparatively at Eurozone, it has been actually dropping for the furthest time and expected to remain sluggish. Japan has not been also doing fantastically well as well. So I think, as what I say, I think even world trade is likely to remain a little slow in lieu of all the downside risks. So I mean, it's for one thing, we will say it's too early to actually comment or say that the manufacturing industry has actually bottomed out, and that we do not feel that way. Although it seems encouraging, the results, but in the longer term, we believe that all these cyclical effects is likely to weigh in and actually benefit gold prices. So okay, I think I'll touch a bit on the US economy. I think this is important, as one of the very important factors that you want to see for gold prices is if the Fed actually raise rates. What is their position on monetary policy? Because this is going to have a big impact on the dollar and also a very big impact on the gold prices. So the first thing, if we look at consumer confidence, I think we see that there's a sharp drop before it rebounded a bit, I think boosted market sentiments, before coming down. So we feel that consumer confidence, I think, is still likely to remain a bit weak. There was a modest bounce in the start of the year, but I think first quarter consumption will be still won't be as positive as some of the markets has actually expected. So we feel that weakness in consumer confidence, and also if you look at unemployment rate, although unemployment is positive, but this is a lagging indicator. So we feel that all this has the deterioration has been felt. I think the effects have been seen, the slack has been seen in U.S. economic conditions. So we do not think that it will actually jump with the absence of fiscal stimuluses or even a looser monetary policy. So if we look at also retail sales, for example, which is in blue, I think it's rather volatile, but it's also shown for a downturn. I think it's actually weakened by quite a bit. So even inflation rates, which have shown for positive conditions in 2018, right, have started to dip. So subpar inflation, very subdued inflation rates. I think the Fed will be very cautious on raising interest rates, as it might actually drop further. So I think overall, our expectations is that the Fed is unlikely to raise rates, at least for this quarter. But I think the key question is we want to see is if the economy starts to slacken furthermore in the second half of 2019, will the Fed actually cut rates? So that yet to be seen. I think so that is actually a very important factor that I wish to highlight, because that has a huge impact on gold prices. So okay, I'll just give you a short view. Okay, where does the US economy stand in 2019? I think we feel that there's growing headwinds from a very fundamental standpoint. Monetary policy, they've hiked it for the ninth time. Although they've stressed for patience, I think this is likely just going to support or keep market sentiments, strong. But from a fundamental perspective, it will do little to lower downside risk. Political divide in US policy will impede any additional economic stimulus, as they will seek to actually not raise interest rates. What I mean is that they'll prevent the debt levels from growing up too high. So even the US presidential election 2020 campaign, I think it will raise some geopolitical risks. I think the Trump administration has to keep its mandate. He might have to promise voters and actually try to be more tough on this America First policy to some of his allies. I think that is going to raise some risks as we near the second half. We're going to see some rhetoric as usual, and this might actually raise geopolitical risks and be beneficial to gold if the economic conditions also remain weak. So with that, I think the key question of my summary is that if the Fed really does, I think the Fed policy is likely going to be accommodative, no hikes. But if it actually hikes, it's going to weaken market confidence, as markets are afraid if they can actually, the economic conditions can actually undertake all this stress. But if they cut rates, it's also not going to be beneficial for the dollar. So both ways, I think it's going to be beneficial to gold prices. So that is one reason why we are still fundamentally quite positive, at least for the second half of 2019. So I'll just give you a little technical analysis for the US dollar and our view, just to show where gold is or US dollar is going in the second quarter. So we feel Fed policy likely going to be accommodative. We postulate for rangy conditions. Overall, we feel the dollar, has failed to actually break out. We feel the upside gains for now look severely limited. So we feel this will be likely range bound towards the downside for the second half. So the first quarter, but for this quarter, we feel it's going to be range bound. So with it being range bound, that is actually one of the key reasons why it's actually extending a lot of pressure to gold prices. As a strong dollar, right, and a resilient dollar actually causes a lot of headwinds. It actually impedes gold prices, as the dollar is a interest-bearing asset, well, gold unfortunately isn't. But in the longer run, if the Fed actually cuts rates and the economic conditions slows, geopolitical risk is high, it will contribute to weaker conditions for the US dollar. And we find that the possibility, if what we predict or postulate holds true, the likelihood of a Fed fund cut in interest rate might stand tall. But for now, for this quarter at least, we don't foresee that happening. So gold price, the dollar is likely to range within this about 61.8. I think in our view is about here to about 38.2 for this quarter at least. So actually, why is the dollar, I think, important? I just wanted to show this for some of our viewers who might not be as familiar, is that the gold dollar has a very strong, I think, correlation. If you look at it from a 6-month chart, right, we can see that actually sometimes it goes to about a negative 0.6, which is like for every time that I think gold prices go up, there for every 10 times that gold prices go up, likely the dollar will go down 6 times. So I think there's a very strong actually relationship between gold and dollar. And I think if for some of our traders or investors who wish to look at it, whether what is actually moving markets or moving gold, I think it's always good to look at the dollar. So there's this up and down scenario, and it's easier to appreciate the key drivers for gold prices, right, in the longer term. Okay, so I think I want to cover a bit, right, on China, the world's second biggest, largest economy actually. So once again, I'll say it's too early to call for recovery, although there's a sharp uptick we see over in February and March, right, because of the dovish turn by all these central banks and stimulus program. We do not think that it would actually really raise GDP and actually keep global growth going up, regardless of the success in the US-China trade tensions, because cyclically, if you look at China, they have begun the financial deleveraging program for the last 2 years, and this effects slightly stand true. Fiscal stimuluses might prevent a further drop, but it's unlikely that it will raise GDP to like 6.7%. So if you, as we have seen, I think today yesterday the Chinese government has actually stepped out and spoke out on fiscal policy. So we've seen that support is likely to actually slow down and actually wane. So with all these supply side reforms, that is being carried out, we feel that it's going to also actually soften economic conditions. So overall, if we look at the Chinese PMI, it's been on a downtrend. I think it's unlikely to sustain. It's just going to stay, keep constant for the longer term. Also, we look at retail sales, fixed asset investments, both have been going up. Gentle uptick, we think we see, but overall, it's still on the downtrend for the past 3 and 4 years. So I think at least I would say for the shorter term, for actually Q2, we expect that the stimulus will show up growth for the next few months. Yeah, but with them, I think intending to actually stay neutral for the quarter, this is going to weigh in on the economy on the second half. So I think in the short term, I think risks are still skewed to the downside. I think all this has not there's a lot of structural headwinds from all this. So we expect that actually the GDP to remain quite weak. So this is likely to also be beneficial to gold prices in the longer term. So in a nutshell, I sum it up my point on global economic conditions. Global growth weakness will likely persist for 2019. US GDP, lackluster results. Chinese policy, short growth, but I think this effect is very moderate. Eurozone economy also soft. Japan, global demand will also soft. So I think overall cumulatively, right, that's why we call it this as a very synchronized global slowdown. I think trade has been also quite subpar. But I'd like to stress that this is very structural, cyclical. It's not going to be a very sharp downturn. It's just going to slow, soften. It's not going to be a recession. So I think that's something that we should be very clear. Okay, so next, as we move on, I think I would like to share a bit on the rise of populism in global politics and how does this actually affect and support gold prices. So we see that with all this populism is likely to enhance market volatility, create a lot of pain points for global economic conditions. So investors, when investors are actually fearful or uncertain on what lies ahead, there's a lot of people look for safe haven assets. So safe haven appeal actually stands tall. So we see, of course, as I spoke about the USPE 2020 campaign, America First foreign policy, we have seen it. We have seen them pull up from NAFTA, renegotiated. Now it's the new deal they've put out of the TPP. Also, I think US-China trade tensions have actually started to cool, but US-EU on the Boeing carriers are starting to build up. Aircraft subsidy issues. So I think there's a lot of implications. Even in the last quarter, we saw a government shutdown. So with that, it's quite hard to pass, I think, very constructive policies or even accommodative economic policies, as both within the divided House and Senate. So with that, I think we're going to see, we feel that it's going to be quite disruptive if you look at it in totality, so that it's going to actually benefit safe haven appeal, keep it a bit strong. So although there's even look at US-China trade dispute, the political climate, I think in our view, it still remains extremely fragile. So because there are other political considerations, economic considerations to look out for. So I think although there's the market optimism, I think markets have been very optimistic as it's coming close to a 9-month trade war. But overall, we think this will not be the factor to raise global growth prospects. So even US-EU trade tariffs, this is ongoing right now. I think we have seen all this to raise trade barriers. I think this is also something that will actually keep gold prices solid. So Brexit, of course, we have seen the extension on divorce till October 31st. I think market confidence has been weak overall in the UK, although actually PMIs has been quite positive, but I think this is going to impede, I think, market sentiments. So Brazil, Italy, I think there's something you want to look out for as well. I think you just want to be very careful to see actually how will both parties actually perform. But both are having populist leaders. I think this is going to actually impede the markets, market optimism or in the longer term. So I think we should take note and be more cautious in the longer term. So as we look at this, the next portion I'd like to touch on is rising market risk in in 2019. So actually, if we look at it, the bull market has actually entered its 10th year, the first point, I think. And what we should note is that the US has actually ramped up interest rates for the past 2 years. China has really engaged in financial deleveraging the past 2 years. So all this is likely going to pressure global growth. With the absence of fiscal stimuluses, with China looking to slow it, and US somehow or rather is we look at it, we predict that they are unable to give a very adequate response. I think this is going to slow global growth prospects. Although the Fed is able to cut rates, to stimulate the economy once more, but I think they're opting not to do that, at least for this quarter. So I think when it really happens, right? Yeah. So I think that it will also raise, I think, Bullion appeal. So even if you look at it from an economic cycle, the 4 stages, right? We are really at the late stages of the expansionary phase. We can see indicators moving up. I think interest rates have rose. The yield curve has flattened. I think we're in the 10th year. So I think we don't think that the turn is going to be at this 2019, but we think that there are rising signals that might boost safe haven appeal and safe haven demand in the coming term. So we can saw also, as we see over here, I think the yield curve is inverted. I'll show you slightly later as well. So global equity markets, of course, what we feel is that it's likely to break 3,000. I think the S&P, but it's very volatile. I think the upside potential still remains rather limited, but downside is still rather high on the high side. So okay, I just want to touch a bit on yield curve inversion, so that some of our investors might understand. So in a nutshell, right, interest rates in the yield must compensate investors, I think, in the longer term. As if you hold a position for a longer time, you're expected to be compensated more for the risk. But a yield curve inversion is a phenomenon that actually happens when investors do not feel good and feel confident about putting in their money on the US treasuries in the shorter term. So that is why they will seek a higher form of compensation. So that is where the short-term yield curve actually exceeds the longer-term yield curve. So in our sense, we always say it flattens or it actually becomes negative. So traditionally, I think what it means is that if you look at it historically, right, when the yield curve actually went negative, the 2-year, 10-year, especially, it had recessionary effects. So economists actually considers this a very reliable bellwether for impending recession. So what we see now, for example, the 2-year, 5-year spread, is really negative. So even if you look at here, in 2006 it went down before it scooped up again. Then recession came in around 07, 08. Even from here, dot-com crisis is the same as well. So I think all this is the first yield curve inversion spotted in 2018, right? I think investors were a bit more were quite afraid actually. So actually that's one of the reasons why there was a very sharp sell-off. But of course, I think which is the one that is, I think, more important, right? It is the 2-year, 10-year spread. So now we can see that for the past, I think, 5 years, it's been flattening severely, although there's a gentle uptick, right? but we feel that it might flatten further in 2019. So that's why we are saying also, although we don't feel that a recession is on the way, but it shows that the market is starting to slow, I think showing a lot of signs of exhaustion. So with this aspect, you will see as we look back, right, 06, 07, and also here, we can saw after about 18 to 24 months, if it really inverts, right, I think that is one way you can see, be a bit more careful on if you are in the cash market. So that's also why we feel that if historic patterns actually hold true, right, the economy will turn maybe in 2020, 2021. I think that is something that you want to actually pay attention to. I think monitor economic fundamentals a bit more. So lastly, I think on this, right, I would say, so in the fourth stage of late stages of economic expansionary phase, right, traditionally you see that there's a lot of volatility. So I've pulled out the US S&P 500, NASDAQ, and also Russell. So you can see that actually from 2016 to 2017, largely bull market all the way up before we saw sharp falls, sharp volatility around this area. I think this is due to US-China trade tensions, sanctions, tariffs, and also for this, we're seeing a slower growth and heightened geopolitical risk before a sharp bounce was found when actually the US actually promised to be patient with monetary policy, and China actually pledged to shore up fiscal stimuluses. So overall, we feel that it's very reflective. Actually, it mirrors in the later stages. If you look at it, right, and from the financial standpoint, you can see that market confidence is quite weak and it's still quite shaky. So that is why our view is that although the recovery has been positive for the first half, we feel that all this risk aversion, and corporate earnings being weak in the longer term, this is likely going to pressure. I think the market expectations has been a little too optimistic in our view. So overall, with this should likely recede, and if risk sentiments actually recede, right, then it's going to be quite positive for gold in the longer term. So also, I think if you compare the VIX index, I think for volatility according to S&P, right, we can see actually it's very sharp. I think as compared to the rest, we can see very sharp drops, and we can see very volatile. So I think the implied volatilities volatile markets have been cited in late expansionary phase. I think comparatively to VIX, although there have been some volatility as well, but we have yet to see such violent movement. You see comparatively as 2018 and 2019. So we think that in the later stages of the bull market, whatever that is, how the market's showing, if it really goes against the consensus, where corporate earnings actually fail, it might be extremely volatile. The drop might be actually quite sharp. So okay, I think besides, as I've shared more on our view, I think we're rather downbeat. In the sense that we feel that global growth is going to slow, going to soften. But is there any possibilities? I think some of our viewers have asked me before on the bright spot in the global economy. If what we say if what we postulate or assess doesn't really stand true, right, there's a possibility that it might dampen gold prices. But I think we have to see we do not think that this will happen. But if strong US growth is being achieved through accommodative monetary policy, trade truce, and a sharp expansion in emerging markets, and a sharp recovery in Chinese business sentiments, I think this is likely going to dampen bullion appeal. But overall, it's quite difficult, I think, to see all four in light of what we have just stated, the structural and cyclical slowdown. Okay, so lastly, I think before I'll just go through a quick one, technical analysis for spot gold. So overall, I think for the second half of 2019, especially come Q3, right, we think that we are quite bullish on gold, especially that prices have entered a bearish correction phase. So we feel that the synchronized global economic slowdown, positive to gold, rising populism in global politics, supportive to gold, and all this with market risk that we speak about. So I think I wish to reinforce my points that from softer economic prospects, heightened geopolitical risks, and looming market uncertainties, right? All this are going to actually support gold prices. Dovish, well, of course, we have seen what will happen is that, however, we do not foresee, I think, like the other houses who think that gold price might actually break 1,005 or 1,006 this year. We do not think so, because the central banks still have some room. They can cut rates, and China can actually implement very strong fiscal stimuluses. So overall, we feel that this is going to these three factors are going to boost prices, maybe test maybe 1,375 again, but all this will actually keep gold prices measured. So the growth will be measured. I think that's what we're trying to say. So I think overall, we look at it from a monthly perspective, right? We see that gold for the past 5 years has been trapped, I think, within this range. So what we feel is that the visit, if what we postulate does stand true, gold prices might revisit the 23.6 mark, which is about 1245, as we said earlier on, and then it might, go up to, it might challenge the record high in 20 in 2019, actually this year. So I think overall, if we look at it from a technical perspective, right, I think that this bearish correction is going to actually give some selling point to what's going to happen. But I think if you look at it, right, first thing I would say is that first it has to break above 1278 and 1302 before I think you would like to affirm that it might challenge the next 1325 or 1345. So I think I wouldn't be, especially as it approaches the 1245 mark, I will be a little more careful. I'll try to look for signs of weakness, maybe on the doji candle, maybe especially something like this, signs of weaknesses here before I actually, assess for whether gold prices are on the going up a little further, or is it going to, soften quite a bit, just soften a bit more. So I think yes, so that is our trading outlook. We are still fundamentally quite bullish. So we look likely to us, in the second half, it will test, 1345 or maybe even 1375 in the longer term. Okay, just to give you a bit takeaway market wrap, I think you want to look for US Federal Reserve monetary policy guidance. Q2, we postulate accommodative patience. Second half, looming stronger chances of it cutting rates. But for now, the market hasn't really priced in for a rate cut, but I think we are paying very close attention. US yield curve inversion, 2-year, 10-year spread. I think you have to be very careful. If it really inverts, right, I think this is a looming sign. Trade protectionism, US China, US EU trade relations, you want to watch as well. And of course, as I said, the market risk, economic conditions, all this, something that you really want to pay attention to. So, okay, just to give you a quick one, this is a quick snapshot of our house view on the respective asset classes. So I think this is how actually we form a viewpoint. So 2019 macroeconomic outlook, we feel that global central banks keep rates neutral first half. Lagged effects of deleveraging policies slow economic growth. Equities, of course, with higher borrowing costs, is going to constrict market liquidity. It's going to cause weakness for corporate earnings. Overall, I think the risk and return ratio stalls, softer asset prices for sure. So Brexit uncertainties, is going to also impact market confidence. I think the emerging markets, if it actually developed economies actually weaken further, I think it's going to impede growth as well. So overall growth as a safe haven asset is still bullish in lieu of all these reasons. I think the balance of risks remains tilted, I think, towards the downside. But I think I also want to be, I also want to say this, that we still feel that, overall, I think for gold to actually break 1375, there needs to be very strong recessionary effects, which we do not foresee for the next 2-3 years at least. I mean, for at least in 2019 and 2020. So as what we said, the central banks still have some ammunition to prevent that. So okay, I think the last part, I think I just want to say, if any of you have any questions, I think please feel free to put it in the question box. If not, so that I can answer you later. But for now, I'll just go through quick 5 minutes to go through a product wrap. How can actually investors trade gold for some of our friends who are not so familiar? So the first thing I think we foresee is that there will be, if you want to look at some positive market variables for gold, I think you can see that US dollar weakness, I think heightened geopolitical risk, I think sell-offs in financial markets, or the US FOMC officials slashing interest rates, and further signs of weaknesses in economic growth. This is actually going to be positive to gold prices. Okay, so I think this is something that you want to see, you can use as a weightage. But overall, I think you should look at the bigger picture and not actually just look at the news. Sometimes it can be a bit misleading. Sorry. Yep. So okay. So actually, what's there in the markets for gold? How do we actually trade gold? There are various, I think, options. I think first is you can look at futures. I think there's CME offers gold futures, gold and E-mini. So both are leverage trading. Do note that leverage trading is not for everyone. So I think I advise, please speak to your account managers or respective sales representative, and they can advise you better. But to start off, I think initial margin for a standard contract is 3,740. I think mini is about 1,870 half. So there's also spot gold for some of you who might be able to do it. due to regulations and regulatory requirements, some of you might not be. But just to take note, I think gold, you can go up and down to micro, 1 ounce or even 100 ounce per lot. So of course, the initial margin can differ from standard $4,620 to 46.20. So we offer this on a Phillip Metal Trader 5. So okay, how do you actually trade, I think, gold? I think if we look at it, right, you can actually trade gold through futures, but I'm just going to show with you, I think, upswing. So if, let's see, for example, a trader actually assesses for upside potential for gold prices. I think there's, of course, there's stocks, there's ETF, but the traders decide to go for long on gold futures. There are various reasons why he decides to do so, but imagine if he decides to buy it, the price is, assuming it's 1,300, contract size 100 ounce. Your initial margin for 5 contracts will be about 18,700. But if on the next day, for example, you see gold prices trading at 1,310, so his profit and loss will be $10 per ounce times 100 ounce, because there's one contract, so it'll be $1,000 per contract. So total, right, because he bought 5 contracts and he closed it out, he'll get 5,000 in total profit. So that's how it actually works. So do note that risk and reward is still in tandem. So if you lose money, right, if the position is 1,290, it will be the other way around. So actually, how can you, or why should you trade, I think, gold futures, right, rather than ETFs or stocks? I think first thing I would like to say is that I think futures are the first responders. So I think it's always a little faster, and there's direct play, market-based considerations for securities, and ETFs. There might be other considerations. So of course, brokerage charges is also cheap for futures, and it's leverage trading. I think capital efficiencies, you can go smaller for higher. Market liquidity, of course, is very diverse based. There's props, there's commercial hedges, funds, and of course, clearinghouse safeguards if you look at futures. And of course, it's close to 24 hours trading for COMEX gold, even spot gold. Okay, so I think I'll just go into the Q&A. For those of you who I think have questions, kindly write them in, and I will start to answer and go through them. So just give me a minute while I screen through the questions. So the first question, actually, I see it by Mr. Chia. I think which direction is silver going? So I think, okay, there are considerations, right, between silver and gold. Although traditionally both are precious metals, I think it's actually, the both moves are quite similar, right? The correlation is quite strong, but you must understand that I think for gold, right, it is a precious metal. It has safe haven qualities. Silver as well it has, but silver is an industrial metal. So sometimes you have to look at industrial demand, PMIs, you have to consider all of this, the industry, where is it going. Whereas gold, actually, we can see, for example, that you have to see if the central banks start to hoard or buy gold, this is going to actually push prices up faster than actually silver. So although the correlation is strong, you have to, comparatively, you have to look at both. So I think for me, for at least for the second half, right, I would say, I think for now, I am, for this quarter, for the second quarter, I am less bearish on silver than I am for gold for the second quarter of 2019. But for the second half of 2019, right, I am more positive on gold than silver in lieu of the weakness in global economic growth and how the market's going to react for gold. More positive for safe haven demand. But for silver, the weakness, it might actually pressure, although it might push gold price, silver up, price up, but it might actually pressure because the industrial demand is actually weak. So we have to look at other factors like for silver. It's both looks very similar, but it has quite different properties as well. I'm just going to wait a while more. I don't actually see much questions for now. But I'll just wait to see if there's more questions, and I will try to answer you. Once again, I would say, if you have any questions, I think you can speak to your AEs, and you can write it in. I will do my best to answer you. It might be a bit slow, but I will do my best. So primarily I cover gold and a bit of oil. Oil, I do cover oil as well. So primarily commodities. So for the indices and FX, we have another analyst. So if you have any questions, you can just always feel free to write in. So now I'll just wait, for another minute, and I'll see if there's any more questions. Okay, I think I don't see actually much questions coming in. So I think before I wrap up this session, right, I would just say, um, I think we feel that the recent bout of weakness in global economic growth, right, will actually persist longer than what is actually than the consensus in the financial markets. So I think whatever we see the U.S. Policy, I think we have some questions coming in, but I'll just complete what I'm saying. So I think this disappointment in this economic performance is likely to disappoint, I think, investors in the longer term, and this is likely to actually push gold prices up. So I think for us, we feel that safe haven demand is still relatively strong, but for this quarter, right, there's a lot of pressure, a lot of headwinds from all this as risk sentiments remain strong over the various factors that I've discussed earlier on. So I think, yeah, for now we still see that the risk, I think the balance of risk for the global economic conditions is still tilted towards the downside in the longer term. But okay, let me just answer some of the questions. I think, does it mean that the market slows down in the future? I think gold prices is going up soon. So yes, in a sense, what we are trying to say is that with global economic conditions slowing, and as risk assets, right, things like equities go down, the investors have to look for somewhere to actually invest or park their their funds or their investments. So gold is known as a safe haven asset. I think it's very strong. Historically, it's proven value maintenance. So we do not feel that it's going to it's going to maybe shoot up to 2004 or 2005, but the chances of it moving up, right, towards in the second half, right, towards maybe that retesting previous highs is very strong, as people, they need safe haven shelters. So safe haven assets have shown to have a very strong trajectory. So I think in times of like economic and financial stress, right, we have seen many times that the metals price has actually risen sharply when US dollar or US equity markets slump. So we actually expect for things like the S&P 500 to drop. So we feel that all this will likely boost safe haven assets in the longer term. Okay, let me see what's the next question. I think, okay, so what is the correlation between Japanese yen and gold? So both Japanese yen and gold, right, are safe haven assets. I think considered safe haven assets, just like bonds. So overall, we've actually have a very positive view, right, of safe haven assets. But what I would like to stress is that I think we should always look at both, right? Although there's a very strong, there's some positive correlation between the Japanese yen and gold. You have to look at various factors. One is the Japanese yen. If you look at the pair, maybe with the US dollars, right? US dollars, right? You have to look at monetary policy. You need to look at interest rate differentials. So I think overall we are actually positive on both, but because in Japan is a negative interest rate policy, so that is something that I think you want to note. But for example, if we go with the assessment, or if, for example, we postulate, I make a hypothesis that the US actually cuts interest rate sharply, I think this too is definitely going to benefit. So I think, but of course, you want to look at both as, although there's some similarities, I said that both are still different entities and there are still different considerations. For Japan, for the Japanese yen, I think you will need to look at monetary policy and economic conditions for sure. For gold, I think you want to safe haven assets. You need to look at equities and also you look at bond yields and also the US dollar. So the other factor is oil. So I think, okay, oil prices are actually rising quite rapidly, we see, because of all this geopolitical influence and all these cuts. So how is this actually going to impact gold prices? We feel that if oil prices actually stay relatively high over for the next part of the year, it's going to create actually a lot of stress on economic conditions. So we actually, for oil, we have, although we feel that this all these geopolitical concerns have actually boosted oil prices upwards, right, tightened supply. We feel that in the second half, right, it might not be as positive as we think. Another key factor for oil is that as we close into the US 2020 PE elections, right, I think the Trump administration is not so inclined to allow oil price to climb above 100 because it's going to severely raise gasoline prices. But in a nutshell, right, what we're trying to say is that if oil price actually do resume like 1890, right, for maybe the whole of 2019, this is going to cause a lot of stress on the economic conditions. So actually, in the long run, it's actually positive for gold as well. So what is your view on the, sorry, just a minute, let me see. What is your view on gold-silver ratio? Do you foresee the spread being narrowed? Okay, so I think is that, okay, for me, to be honest, I am not, I look at the gold-silver ratio, but I don't really focus on this because I have, as I said, gold prices and silver prices, right, it doesn't really, it has to, you have to see. I mean, at some point, if the spread widens or the spread actually thins, right, there are certain ways of, I think, putting in arbitrage opportunity. But for me, I think that it's not so simple, I think, to say that both, I think, will move in tandem as there are other influences. So in a nutshell, what I'm trying to say is that gold, you still have to look at the whole macroeconomic environment. For silver, right, you can be less, you can, piggyback on the macroeconomic environment or piggyback on gold, but you have to really look at industrial considerations, like things like China, how is the PMI, or actually are they, what is the purchase for electronics and other manufacturing goods. So I think this has to be taken into account and this has to be considered. So gold future trading cost, commission percentage, leverage. Okay, so you see for gold futures, right, I think commission wise I'll leave it to your AE to actually advise you. So but for leverage, right, it really depends. So for example, for COMEX gold, right, I think it's about 2 to 3 percent. So the initial margin, as I said earlier on, right, is about this 3,740. So it's around, I think, 3 to 4%. So if you actually buy, there's no because there's no actually leverage charges. So for futures, actually you have to post what we call a margin or a performance bond. So before you initiate a position, right, you're expected to front up a certain margin. So this to prevent yourself, right, if the market goes against you, you don't, the brokerage doesn't suffer over loss. So I think if you just if you buy in a certain position, right, if you start off, you need a certain amount, but then this will be your equity. So largely, I think I'll leave this portion, right, I think, to your the respective AEs, right, or sales representative to answer this question. And I think I'll get the salesperson to contact you actually to explain to you and share your view a bit more on how this is done. So I think you can have more clarity rather than address this over the webinar. Okay, so thank you very much. I think I'm very happy that all of you have stayed till this late. So have a very good evening. Please write in if you have any questions. I actually have the last page over here. You can talk to us for general inquiries of Phillip Futures, or if you are in Malaysia, Thailand, or another country, you can contact your representative. So a very good day speaking to you. I think I will conduct the next webinar, I think, in a couple of months. So I hope to see you again. Thank you so much. Have a good day. Bye-bye.